2022 has been a challenging year for financial markets, with both bonds and stocks selling off at the same time. This has been driven primarily by rising inflation, which has been running hot all over the world and has reached levels not seen since the early 1980s. This inflation initially began to take hold in early 2021 as COVID vaccines were rolled out and as the economy began to recover from the pandemic. While initially thought to be deflationary, the pandemic ended up becoming a powerful inflationary force around the world as consumer demand was supported by government spending, while at the same time the supply of goods was negatively impacted by pandemic-related shutdowns. At first, many pundits thought that inflation would be temporary, but this has proven to not be the case over the past 12 to 18 months, as the market has consistently underestimated inflation. We believe that this is happening because the pandemic also marked the beginning of a regime change towards supply-side inflation, which is structural as opposed to the cyclical inflation we are more familiar with. While overall inflation is very likely to moderate from some of the extreme rates we've seen lately, there are several sources of the supply-side inflation that, because of their structural nature, are likely to persist for the foreseeable future. This includes things like Russia's war in Ukraine and the related sanctions, the reversal of many globalization trends such as trade wars, tariffs, and reduced immigration, a decade of underinvestment in many basic necessities, including commodities, housing, and infrastructure, demographic changes, particularly as the baby boomer generation gets older, and lastly, the ongoing cost of climate change and decarbonization. One of the issues with this type of inflation is that central banks are mostly powerless when it comes to addressing these structural sources of supply-side inflation. And this is because central banks cannot actually produce the things that we need. To make matters worse, if higher rates end up pushing us into a recession, as many market participants believe will be the case, this would likely bring down inflation in the short term, but it could also lead to further underinvestment in supply and potentially drive inflation higher again in the medium to long term. With inflation likely here to stay for the foreseeable future, investors should look for strategies that perform well in inflationary environments, such as real assets. Real assets are long-life, physical assets that often produce essential services and are characterized by high barriers to entry, low maintenance capital requirements, and strong pricing power. Because of these characteristics, real assets can act as a powerful inflation hedge. And this has historically been the case, with real assets performing well on both an absolute and relative basis during prior periods when inflation was above 2.5%. Given our view that inflation is here to stay and will likely remain above this level, we believe that investors would be well served by adding a real assets investment to their portfolios in the current environment. Brompton Sustainable Real Assets Dividend ETF provides diversified exposure to global real assets companies in the utilities, energy, materials, industrials, communication services, and real estate sectors. Many investment fund strategies focus only on one primary sector, but Brompton believes that having a broader investment universe that combines all real asset sectors together enhances the opportunity for capital appreciation while also providing one-stop shopping for investors. Our strategy is to invest in high dividend yielding companies that are market leaders in their industries with strong balance sheets and predictable free cash flow. We believe this is a strategy that provides for better risk-adjusted returns, particularly in an inflationary environment, while the diversified sector exposure mitigates investment risks in a volatile macro environment. To supplement dividends received on the portfolio holdings, we also use an active covered call strategy that helps to reduce portfolio volatility and allows the fund to pay out a higher distribution than it would otherwise be able to do.